Welcome back to my channel where we dive into all things finance and investing for financial freedom. Today's discussion. If you're nearing or in retirement, one key question is, how much cash reserves should you keep on hand? I hope the topics we cover will highlight a range of tools available to you, beyond cash, you can use in concert with cash, to manage sequence risk. If you find topics like this helpful, show your appreciation by hitting the like button. Subscribing takes just a second, so don't forget to subscribe and enable notifications for future content on investing for financial freedom. Your support helps our channel grow and reach other like-minded viewers. Okay, let's get started. There are some really important factors and trade-offs to consider here. First off, the main purposes of having cash reserves in retirement are twofold. Number one, to cover emergencies, unexpected medical bills, home repairs, and any surprise expenses that inevitably come up in life. You don't want to be caught flat-footed. But number two, and this is crucially important, having cash on hand means you don't have to draw from your growth investments, like stocks, during a down market. The last thing you want is to be forced to liquidate depreciated assets in a down market to fund your living expenses and everyday needs. Locking in losses by selling stocks while they're down can severely impact your portfolio's longevity and long-term growth potential. This phenomenon is known as sequence risk, or sequence of returns risk, and it can dramatically reduce the longevity of a retirement plan. Having cash reserves on hand to spend from, during market declines, protects your stocks and growth assets from locking in losses, and enables these to continue compounding during the recovery. So, this brings us to a simple rule of thumb. Most experts recommend targeting 2 to 3 years' worth of your projected annual living expenses in cash and highly liquid instruments, like money market funds. For example, if you estimate needing £50,000 per year in retirement, aiming for £100,000 to £150,000 in cash holdings is reasonable. There's some key reasons why you don't want to hold more cash for the long haul. And that leads us into the next major consideration: the opportunity cost and cash drag of having too much money sitting idle in cash accounts that earn little to no return. While holding ample cash reserves can provide immense peace of mind during volatile market periods, having an excessive allocation to near-zero return assets means missing out on potential growth and compounded returns over decades of retirement. This has been highlighted in extensive articles by renowned retirement experts like Christine Benz of Morningstar, Wade Pfau, Michael Kitces, and Javier Estrada, among many others. Holding too much cash comes at a big cost, in terms of lost upside over decades, and could result in running out of money prematurely in retirement. So while having a cash buffer is prudent, having far too much uninvested capital becomes an anchor, weighing down your long-term results. There's a balance to strike. Now, I know some folks will say, but look at 2022. Both stocks and bonds got crushed, so holding lots of cash doesn't seem so bad. And they have a fair point. 2022 was indeed a highly unusual year, where both equities and bonds were both highly correlated, and both down significantly, due to high inflation and aggressive rate hikes by central banks. But it's crucial to understand that 2022 was an outlier. Historically, bonds have provided valuable portfolio stability and diversification benefits, acting as essential shock absorbers for stocks. We have to go all the way back to 1994, under Alan Greenspan's Federal Reserve, to find the last time equities and bonds were so highly correlated. Throughout most bear markets and recessions, bonds have zigged while stocks zagged, dampening overall volatility in a balanced portfolio. And even in the difficult 2022 environment, short-term bonds were affected to a much lesser degree than intermediate and long-term bond holdings. So having that high-quality, investment-grade short-term bond component still helped dampen volatility. Given the trade-offs between having too little cash versus too much, what portfolio options could balance the priorities of growth and stability? Well, one classic approach is the bucket strategy. There are variations on this, but generally, this divides your assets into buckets: a short-term cash bucket covering 1 to 5 years of spending, a fixed income bucket covering 5 to 10 years, and then a long-term growth bucket invested in stocks for the remaining years. As I discussed in another video, Michael Kitces concluded in his detailed 2014 analysis that a simple 60-40 portfolio, rebalanced annually, matched the performance of the more intricate bucket strategy. That is, he didn't find any tangible benefit to implementing the bucket strategy. Professor Javier Estrada in 2019 was more negative. He found static strategies, like the classic 60-40 portfolio, consistently outperformed all three variants of the bucket strategy he evaluated. So while the bucket strategy might provide psychological comfort, its financial merit has been questioned by two leading experts in the field. Let's just step back for a moment. You could simply set aside cash reserves to cover 2 to 3 years' worth of expenses, without adopting the bucket strategy. That is, you don't need the bucket approach, just to hold cash reserves. It's a simple, grounded, common-sense approach for retirees and investors alike. For example, you can hold 2 years of cash to augment your target portfolio. No changes needed to how you manage your portfolio, no buckets, no separate portfolios per bucket, no complex bucket maintenance strategies, of which there are numerous. Keeping things simple, you could simply hold 2 years of cash and have a simple 60-40 portfolio. The 40% allocation could be further divided into 20% short-term bonds and investment-grade intermediate-term bonds, making up the other 20%. This total return approach, of viewing the entire portfolio in aggregate, has been shown by experts like Kitces and Estrada to consistently perform just as well, if not better, than more complex bucket strategies throughout some of the worst market periods, including the 1960s. This bears a striking resemblance to the simplified 6-year, 2-bucket strategy that I delve into in another video, albeit with a notable refinement. The simplified bucket strategy targets the preservation of 6 years' worth of expenses in the short-term bucket. This usually entails an allocation of around 24% to short-term cash and investment-grade bonds, leaving the remaining 76% invested in equities. In essence, it's nothing more than a simple 76-24 portfolio, structured to maintain sufficient short-term liquidity for 6 years. That's it. While it may not suit more conservative retirees, the single portfolio, total return approach proves remarkably resilient, as demonstrated by Kitces and Estrada, when they tested static strategies under challenging market conditions. To understand the rationale behind that 6-year short-term bucket, it's insightful to examine historical data on peak-to-peak recoveries, following major bear markets. Looking back at two particularly severe bear markets, namely the 2000 dot-com bust and the 2008 global financial crisis, stocks experienced declines of up to 57% from their highs. Remarkably, both instances saw a rebound, with new peaks reached within approximately 4 to 6.5 years. So, the decision to allocate 6 years in the short-term bucket is grounded in historical data, from two of the most challenging bear markets in recent history. However, it's essential to acknowledge that the duration and pace of recovery in the next bear market may differ. For those seeking enhanced protection, you could extend the short-term bucket to 8 or even 10 years. But keep in mind the trade-offs in performance, the longevity of your retirement savings, and the limited historical evidence supporting this, excluding the 1930s Great Depression. There are diminishing returns to fixating on extreme risks. That is, we don't want to go overboard, preparing for absolute worst-case scenarios. Planning for a total, generational downturn like the Great Depression would necessitate holding cash reserves, spanning multiple decades. However, this approach would severely limit growth potential, and will almost certainly result in premature depletion of retirement funds. While 6 years of short-term reserves may be adequate to buffer the deep bear cycles we've looked at, we must also consider the possibility of, and plan for, an extended bear market that persists beyond that timeframe. As always, the greater the certainty you build into your plan, the higher the cost, in terms of reduced upside potential, and the more detrimental the impact on portfolio longevity. Apart from increasing cash reserves, or expanding the short-term bucket within the simplified bucket strategy, there are 4 additional lines of defense. These can be used separately or together, to navigate an extended, severe bear market and mitigate sequence risk. First, maintain a well-diversified portfolio, invested across multiple asset classes, sectors, geographies, and market cap sizes. This avoids any concentration risk in a given sector or geography, and is just good practice for any investor, but it's sometimes worth emphasizing. Consider incorporating broad equity index funds like the Vanguard Global All Cap, and bond index funds focused on investment-grade bonds, such as the Vanguard Global Bond Index Fund, and the Vanguard Global Short-Term Bond Index Fund. These resilient, highly diversified index funds form a robust cornerstone of any investment approach. Additionally, you may opt to include satellite funds for potentially higher returns, such as those targeting healthcare, global technology, global small caps, and emerging markets. Second, implementing dynamic withdrawal strategies can be critically important during extended bear markets. Approaches like the Guyton-Klinger guardrails and the Vanguard dynamic spending rule dial down withdrawals during extended bear markets to reduce sequence risk. There are numerous other dynamic strategies, such as Bengen's floor ceiling and Michael Kitces' ratcheting rule. I'll add links to these in the description. These dynamic approaches, with the exception of the ratcheting rule, provide a set of rules to cut spending when markets are down, instead of insisting on a fixed withdrawal, no matter what. This adaptive approach is key to prolonging portfolio longevity amidst challenging market conditions. However, it's not just about curbing spending. These strategies also allow for spending increases during favorable market conditions. This ensures you get the opportunity to enjoy your hard-earned retirement savings in better times. In summary, dynamic withdrawal techniques enable retirees to smoothly adjust their income streams based on market conditions. This responsiveness is a powerful enhancement for managing sequence risk, and is the secret sauce to extending portfolio longevity in the face of adverse market conditions. Third, rather than relying solely on a dynamic withdrawal strategy to dictate broad spending reductions across the board, we are probably more qualified to determine what the focused spending cuts should be. Creating a discretionary spending tier by categorizing expenses as essential versus discretionary can provide more flexibility. Essentials like food, utilities, housing are prioritized. But discretionary spending on holidays, dining out, hobbies and subscriptions can be reduced in lean times, without impacting livelihood. Implementing a two-tiered budget enables individuals to adjust discretionary spending levels as needed, reducing spending during down markets. Budget for this when planning your retirement, so you know in advance how much discretionary spending you can flex. Finally, the fourth line of defense is having additional income streams outside your investment portfolio. More generally, any additional income will alleviate the pressure on your retirement savings, which can't be a bad thing. This could be a part-time job, a freelance contract, a side hustle, rental properties, or fixed-term annuities. State pension falls into this category too. Finding £5,000 of extra annual income can dramatically reduce the strain on your retirement savings and lower your withdrawal rate burden. For example, let's say you started retirement targeting a £40,000 annual withdrawal from a £1 million portfolio. This is your standard 4% initial withdrawal rate, but the principle stands, regardless of the rate. Let's suppose you earn £5,000 a year from a part-time job, or from letting out one of your spare rooms. This means you need only draw £35,000 from your investment portfolio, effectively reducing your withdrawal rate from 4% down to just 3.5%. Reducing your withdrawal rate by 0.5% can significantly enhance portfolio longevity. In concert, these four complementary strategies can be deployed as additional layers of defense against sequence risk, supplementing the use of cash reserves. Whether utilized independently within a static 60-40 portfolio, or as part of a framework like the Simplified two-bucket strategy, these complementary strategies enhance portfolio resilience. But let's get back to the original question. How much cash should you hold in retirement? The prudent starting point is likely 2 to 3 years' worth of living expenses. Exceeding 3 years, and you are in cash drag territory, with lower expected returns and portfolio longevity. Personally, I suggest maintaining 2 years' worth of cash, as part of a total return approach, such as the Simplified two-bucket strategy. This approach, with its dual safety and growth buckets, strikes the right balance of short-term liquidity with long-term growth. A modest cash reserve, when combined with diversification, dynamic spending strategies, and overall portfolio rebalancing, can help manage sequence risk while optimizing retirement outcomes. In closing, it's essential to recognize that cash is just one element of the broader retirement plan, and must not be considered in isolation. Therefore, its role must be evaluated within the context of these strategies and options. I hope the topics we covered today have highlighted the range of tools, beyond cash, you can use in concert with cash, to manage sequence risk. Remember, the best strategy is one that meets your unique financial needs, risk profile, and retirement goals. As always, for a personalized plan, please consult a financial advisor. Thank you for your time. Don't forget to like, share, and subscribe for more content. It will really help our channel grow and reach more like-minded viewers. So, how many years of cash were you planning to hold in retirement? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.